Three market crashes. Three generations of billionaires. Same playbook. 1929. Bernard Baruch exits the market in August, 2 months before the crash. Made millions shorting stocks on the way down. Then bought industrial stocks at 80% discounts. Turned his fortune into one of the largest in America. 2008. John Paulson makes $4 billion shorting housing. Uses the cash to buy bank stocks at 90% discounts. Doubles his wealth again on the recovery. 2025. Warren Buffett holds $325 billion in cash. That's not defensive positioning. That's ammunition. Here's what most people miss. They think billionaires get lucky. They think crashes are unpredictable. They're wrong on both counts. Billionaires follow a documented four-stage blueprint. It's been used successfully in every major crash for the last 100 years. Stage 1. Exit positions while everyone's still buying. Stage 2. Build short exposure while markets keep rising. Stage 3. Issue public warnings that nobody listens to. Stage 4. Deploy cash reserves when assets are liquidating at 70% discounts. Right now, in 2025, we're watching Stage 3 play out in real time. Jeff Bezos sold $13.5 billion in Amazon stock this year. Mark Zuckerberg dumped over $1 billion in Meta. Jamie Dimon sold JP Morgan shares for the first time in company history. Insider selling just hit a 9-to-1 ratio. 9 sellers for every buyer. That's not rotation. That's evacuation. And while they're selling, they're warning. Ray Dalio says we're in a debt supercycle. Stanley Druckenmiller says valuations remind him of 1999 and 2007. Both preceded 50% crashes. The blueprint is executing. The pattern is repeating. And if you understand how it works, you'll see exactly what comes next. The elite exit cycle isn't theory. It's documented behavior repeated across every major market collapse in modern history. To understand how it works, you need to see it play out once, in full detail, so the pattern becomes unmistakable. We'll use 1929 as the template because it's the purest example. No circuit breakers. No Federal Reserve interventions. Just the raw mechanics of how sophisticated investors extract wealth during systemic failure. Let's talk about the 4 stages in 1929. Stage 1. Silent liquidation, 12 to 18 months before collapse. Between January and September 1929, while the Dow Jones climbed from 300 to 381, a specific group of investors began converting stock positions to cash. Not because they predicted the exact date of the crash. They couldn't. But because they recognized that margin debt, the amount borrowed to buy stocks, had reached $12 billion. That was 20% of GDP. When stock prices are rising, margin debt is invisible. But the moment prices decline 10%, margin calls trigger. Investors must deposit more cash or their shares are automatically sold. That forced selling creates more price declines, which trigger more margin calls. A liquidation cascade. Joseph Kennedy understood this. Bernard Baruch understood this. They'd both profited from the 1907 panic using the same pattern. So throughout the summer of 1929, they sold. Quietly. No announcements. No warnings. Kennedy later said he exited after his shoe shine boy gave him stock tips. That's the myth. The reality was leverage analysis. By September 1929, Kennedy and Baruch were 90% cash. Stage 2. Short positioning, 3 to 6 months before collapse. In Stage 2, these same investors don't just hold cash. They actively bet against the market. Kennedy and Baruch both established short positions in September 1929, borrowing shares and selling them, planning to buy them back cheaper after the crash. This wasn't illegal. It was standard practice for professional speculators. The mechanics were simple. Borrow 1,000 shares of Radio Corporation at $100. Sell them immediately for $100,000. Wait for the crash. Buy back 1,000 shares at $20. Return the borrowed shares. Keep $80,000 per 1,000 shares shorted. By October 1929, Kennedy had short positions across multiple stocks. He wasn't causing the crash. He was positioning to profit from leverage unwinding that he knew was mathematically inevitable. Stage 3. Public warnings and plausible deniability, weeks before collapse. This is the critical stage that most people miss. In late September and early October 1929, a small number of economists and financial commentators began issuing warnings. Roger Babson, a statistician, gave a speech on September 5 predicting a crash. The market dropped 3% that day, an event later called the Babson break. But then it recovered. Most investors ignored the warning. Babson was dismissed as a perpetual pessimist. But here's what matters. After the crash, Babson and others who'd issued warnings could say they'd tried to alert people. They had plausible deniability. They'd warned the public. It wasn't their fault retail investors didn't listen. This pattern repeats in every cycle. The warnings come, but they come when most people are still making money and psychologically incapable of selling. Stage 4. Acquisition at collapse prices, 12 to 24 months after crash. The crash began October 24, 1929. Black Thursday. The Dow fell 11% in one day. By October 29th, Black Tuesday, it had fallen 23% in 48 hours. Margin calls forced automatic liquidations. Banks that had loaned money against stock collateral went bankrupt. The cascade accelerated. By July 1932, the Dow bottomed at 41, down 89% from the September 1929 peak. Kennedy and Baruch made millions shorting stocks on the way down. But stage 4 is where generational wealth was built. In 1932 and 1933, Kennedy used his cash reserves to buy entire companies at liquidation prices. He acquired film studios, distribution networks, and real estate. Assets that had been valued at millions were selling for thousands. By 1935, Kennedy had turned his 1929 fortune into one of the largest private fortunes in America. Baruch did the same, buying industrials and commodities at Depression-era lows. The pattern was complete. Exit, short, warn, acquire. That was 1929. The template. Now let me show you how the exact same four-stage cycle played out in 2008, with different names, different assets, but identical mechanics. And then we'll map where we are right now in 2025. Stage 1, silent liquidation, 2005 to 2007. Michael Burry ran Scion Capital, a small hedge fund. In 2005, he obtained loan-level data on subprime mortgages. Not the ratings, not the marketing materials. The actual loan files showing borrower incomes, debt ratios, and loan terms. What he found was systemic fraud. Adjustable-rate mortgages given to borrowers who couldn't afford payments once rates reset. Stated income loans, called liar loans, where borrowers claimed six-figure incomes without verification. Loans with 2% teaser rates that would jump to 8% after 24 months. These mortgages were packaged into securities, rated AAA by Moody's and S&P, and sold to pension funds as safe investments. Burry concluded the entire structure would collapse, but he couldn't short mortgage-backed securities directly. The instruments didn't exist. So he approached Goldman Sachs, Deutsche Bank, and other investment banks with a proposal. Create a new financial instrument. Credit default swaps on subprime mortgage bonds. Essentially, insurance that paid out when the bonds defaulted. From 2005 to 2006, Burry bought $1.3 billion in notional value of credit default swaps. He was paying insurance premiums every month. Losing money. His investors revolted. They thought he'd lost his mind. Some demanded their money back. Burry locked them in. He understood stage 1. Exit the consensus trade before anyone else sees the collapse coming. John Paulson, running Paulson & Company, came to the same conclusion in 2006. He'd analyzed housing prices relative to median incomes and rents. The divergence was historically unprecedented. In 2000, median home prices were 4 times median income. By 2006, they were 7 times median income. The gap couldn't sustain. Paulson launched a dedicated fund to short subprime mortgages. He raised capital, bought credit default swaps, and waited. Both Burry and Paulson were in stage 1 from 2005 through early 2007. Exiting the housing bull market consensus. Building short positions while everyone else was still buying. Stage 2. Short positioning, late 2006 to mid-2007. By late 2006, Burry and Paulson weren't just holding defensive positions. They were aggressively shorting. Burry expanded his credit default swap positions to cover CDOs, collateralized debt obligations, which were packages of mortgage-backed securities. He was betting not just that subprime mortgages would default, but that the entire structured finance market would collapse. Paulson did the same. By mid-2007, his fund had $25 billion in short exposure to subprime mortgages and related securities. He was paying tens of millions per month in premiums, still losing money. still being called insane by other hedge fund managers. But they'd studied the pattern. They knew that in stage 2, you have to endure losses and ridicule. Because when stage 3 arrives, the payoff is exponential. Stage 3, public warnings, early to mid 2007. In February 2007, the first subprime lender, New Century Financial, announced it was insolvent. The stock collapsed. Mainstream media briefly covered it, then moved on. In June 2007, two Bear Stearns hedge funds that had invested in subprime mortgages failed. Again, brief coverage, but most investors dismissed it as isolated events. Here's the critical detail. By mid-2007, a small group of analysts and economists were issuing public warnings. Nouriel Roubini, an economist, gave presentations predicting a housing collapse and bank failures. He was mocked, called Dr. Doom. But after the crash, Roubini could point to those 2007 warnings and say he'd tried to alert people. Paulson began giving interviews in late 2007 explaining his short thesis. Not to warn retail investors. They wouldn't listen anyway, but to establish a public record. Plausible deniability. Stage 4. Acquisition, 2009 to 2011. The crash accelerated through 2008. Bear Stearns collapsed in March. Lehman Brothers declared bankruptcy in September. The S&P 500 fell 57% from its October 2007 peak to its March 2009 low. Burry's credit default swaps paid out. His fund made $700 million. His personal take was $100 million. Paulson's funds made $20 billion. His personal compensation was $4 billion, the largest single-year hedge fund payout in history. But the real wealth wasn't made shorting. It was made in stage 4. In 2009 and 2010, Paulson used his cash to buy bank stocks at collapsed prices. Bank of America at $3. Citigroup at $1. He bought billions in distressed debt. By 2011, when bank stocks recovered, Paulson had doubled his wealth again. Burry pivoted to buying farmland, water rights, and gold. Hard assets trading at Depression-era multiples. The pattern had repeated perfectly. Exit, short, warn, acquire. Now let me show you what's happening right now. The same investors, the same 4 stages, the same pattern. Stage 1, evidence, silent liquidation, 2023 to 2024. Warren Buffett, Berkshire Hathaway. In Q4 2023, Buffett began selling stocks. Bank of America, Apple, massive positions liquidated. By Q3 2024, Berkshire Hathaway was holding $325 billion in cash and treasury bills. The largest cash position in the company's history, larger than the entire GDP of some developed nations. Buffett doesn't hold cash unless he expects better buying opportunities. He's not timing day-to-day moves. He's positioning for a systemic repricing. Jeff Bezos. In February 2024, Bezos filed plans to sell 50 million Amazon shares. By November 2024, he'd sold $13.5 billion worth. That's not diversification. That's liquidation. Bezos had held Amazon stock for decades through multiple drawdowns. The fact that he's selling now, at these valuations, signals conviction that prices will be lower in the future. Mark Zuckerberg. Meta stock. Between January and September 2024, Zuckerberg sold $1.2 billion in Meta shares. Jamie Dimon, CEO of JP Morgan Chase, sold $150 million in JP Morgan stock in 2024. His first sale in the company's history. Insider selling across the S&P 500 reached levels not seen since 2007. The ratio of insider selling to insider buying hit 9-to-1. That means for every executive buying their own company's stock, 9 executives were selling. This isn't random. This is coordinated recognition that valuations are unsustainable. Stage 2 evidence, short positioning, late 2024 to early 2025. This is harder to track because hedge funds only disclose positions quarterly with a 45-day lag. But we have partial data. Bill Ackman, Pershing Square Capital. In Q4 2024, Ackman bought put options on S&P 500 index futures. Puts are bets that the market will decline. Paul Tudor Jones, Tudor Investment Corporation. In an October 2024 interview, Jones stated he was shorting long-dated treasury bonds and holding gold. Shorting treasuries means he expects interest rates to rise. which happens during financial stress when the government floods the market with new debt to fund bailouts. Stanley Druckenmiller, Duquesne Family Office. In Q3 2024, Druckenmiller reduced equity exposure to 20% of his portfolio and increased cash and gold to 80%. He later said in an interview that current market valuations reminded him of 1999 and 2007. Both preceded crashes. These aren't defensive moves. These are short positions and collapse hedges. Stage 2. Stage 3 evidence. Public warnings, late 2024 to present. Jamie Dimon, in his April 2024 shareholder letter, wrote that the U.S. economy faced unprecedented risks from inflation, geopolitical instability, and deficit spending. He used the phrase, turbulent times ahead, 3 times. Jeremy Grantham, co-founder of GMO, has been issuing warnings since early 2024 that the market is in a super bubble. He's predicted a 50% decline in the S&P 500. Ray Dalio, Bridgewater Associates, published research in late 2024 analyzing debt cycles. His conclusion was that the U.S. is in the late stage of a long-term debt cycle, the same stage that preceded the 1929 crash and the 2008 crisis. He recommended gold, commodities, and non-U.S. assets. These warnings are public. They're documented. They're establishing the record. When the crash comes, these investors will say they tried to warn people. Plausible deniability. Stage 3. Stage 4 preparation, dry powder for acquisition. Berkshire Hathaway's $325 billion in cash isn't for safety. It's for stage 4. Buffett has said explicitly that he's waiting for better prices. When the market crashes, Berkshire will deploy that capital to buy entire companies at liquidation multiples. This is what Buffett did in 2008 and 2009. Goldman Sachs preferred shares yielding 10%. Bank of America warrants at $7.14 per share, now worth billions. Private equity firms are sitting on $2.8 trillion in dry powder, committed capital that hasn't been invested. That's a record. They're waiting. When asset prices collapse, that capital will be deployed to acquire real estate, infrastructure, and distressed companies. We're in stage 3, preparing for stage 4. Let me show you why this pattern is inevitable, why it repeats, why the same investors win. It's not luck. It's not insider information. It's understanding 3 mathematical principles that govern all credit-based economies. Principle 1. Leverage amplifies both gains and losses. In 1929, margin debt was $12 billion, 20% of GDP. In 2007, household debt was $14 trillion, 100% of GDP. In 2025, total U.S. debt, government, corporate, and household, is $100 trillion. That's 350% of GDP, the highest in peacetime history. When asset prices rise, debt looks safe. You borrow $1 million to buy a house worth $1.2 million. You have $200,000 in equity. But when prices fall 20%, your equity is gone. You owe $1 million on a house worth $960,000. You're underwater. If you can't make payments, the house is foreclosed. Forced sale. That pushes prices lower. More foreclosures. The cycle feeds itself. Sophisticated investors understand that leverage works both ways. They use it to amplify gains during bubbles. Then they exit, convert to cash, and wait for forced liquidations. When assets are sold at fire sale prices, they buy with cash. No leverage. Full ownership. Principle 2. Market crashes are liquidation events, not valuation events. Most people think crashes happen because assets become overvalued, then correct to fair value. That's wrong. Crashes happen because leveraged investors are forced to sell, regardless of value. In 1929, shares of fundamentally sound companies, profitable businesses with real earnings, traded at 90% discounts. Not because the companies were worthless, but because margin calls forced automatic sales. Shares were liquidated at any price to meet debt obligations. In 2008, the same thing happened. AAA-rated mortgage bonds backed by real homes with real borrowers were trading at 20 cents on the dollar. Not because the underlying mortgages were all worthless, but because hedge funds and banks that owned the bonds had to sell to meet margin requirements and redemptions. Sophisticated investors recognize that crashes create pricing dislocations. Assets trading below intrinsic value because of forced selling. That's when they buy. Not at fair value. At liquidation value. Principle 3. The majority always loses because they operate on emotion, not math. In every bubble, the majority of investors buy near the top because of psychological factors. FOMO, fear of missing out. Social proof, everyone else is making money. Recency bias, recent gains extrapolated into the future. These are predictable cognitive errors. Sophisticated investors operate on math. They analyze debt levels, valuation multiples, and liquidation risk. When the math says exit, they exit, regardless of what the crowd is doing, regardless of whether prices are still rising. They understand that timing the exact top is impossible, but exiting 12 months early is better than exiting during the crash. The majority can't do this. Psychologically, humans are wired to follow the herd. Selling while prices are rising feels like leaving money on the table. Buying during a crash, when everyone else is panicking, feels terrifying. So retail investors do the opposite of what works. They buy high and sell low. This isn't a flaw in the system. It's a feature. Wealth transfers from the emotional majority to the mathematical minority. Every cycle, every crash, every recovery. Now let me show you the 3 specific indicators that signal we're in the final stage before collapse. Indicator 1. Valuation extremes. The S&P 500 Shiller PE ratio, price to earnings adjusted for inflation over 10 years, is currently at 34. The historical average is 17. The only times it's been higher were 1929, before the Great Depression, and 1999, before the dot-com crash. Both times, the market subsequently fell over 50%. The Buffett indicator, total stock market capitalization divided by GDP, is at 205%. Historical average is 100%. Above 150% is considered extreme overvaluation. We're 55 points above that threshold. These aren't predictions. They're measurements. The market is priced for perfection. Any negative catalyst triggers repricing. Indicator 2. Debt saturation. U.S. government debt is $36 trillion. Interest payments alone are $1.1 trillion per year. That's more than the defense budget. Corporate debt is $13 trillion, with $1.2 trillion maturing in 2025 and 2026 that will need to be refinanced at higher interest rates. Here's the critical point. In a debt-saturated system, there's no capacity to absorb shocks. In 2008, the government could borrow trillions to bail out banks because debt was 60% of GDP. Now it's 125% of GDP. The next bailout will require borrowing that triggers a sovereign debt crisis. Sophisticated investors see this. That's why they're exiting dollar-denominated assets and moving to gold, foreign assets, and hard commodities. Indicator 3. Insider liquidation velocity. The speed at which insiders are selling has accelerated. In Q1 2024, insider selling was elevated but steady. By Q4 2024, it had doubled. This acceleration matches the pattern from 2007. Slow selling throughout 2006. Accelerating selling in early 2007. Crash in late 2007. Insiders have access to internal company data, revenue trends, profit margins, customer behavior. When they sell aggressively, they're signaling that their own businesses are overvalued. If CEOs don't believe in their own stock prices, why should you? These 3 indicators, valuation extremes, debt saturation, and insider liquidation velocity, have only aligned 3 times in the last century. 1929, 2007. And right now, here's what happens next. Not a prediction, a pattern. The trigger will be something unexpected. In 1929, it was the Haytree scandal in London, a financial fraud that caused British investors to liquidate U.S. stocks. In 2008, it was Lehman Brothers bankruptcy. The specific trigger doesn't matter. What matters is that the system is so over-leveraged that any shock cascades. When the trigger hits, margin calls begin. Investors who bought stocks with borrowed money are forced to sell. Automated trading algorithms detect the selling and execute programmed stop losses. More selling. The velocity increases. Circuit breakers halt trading, but when markets reopen, the selling resumes. Within weeks, the market is down 20%. That's the technical definition of a bear market. At that point, retail investors panic. They sell everything. Mutual funds experience redemptions. Fund managers are forced to liquidate positions to meet redemptions. More selling. The S&P 500 falls 40%, then 50%. Media calls it a once-in-a-generation crisis. Politicians demand investigations. The Federal Reserve cuts interest rates to zero and launches quantitative easing, buying assets to inject liquidity. But here's the critical detail. While the majority is selling in panic, the investors who executed stages 1, 2, and 3 are deploying capital. Buffett's $325 billion. Private equity's $2.8 trillion in dry powder. Sovereign wealth funds holding foreign reserves. They buy assets at 50% to 70% discounts. Real estate, stocks, corporate bonds, commodities, everything on sale. Not because they're catching a falling knife. Because they understand that crashes overshoot to the downside just like bubbles overshoot to the upside. When the S&P 500 falls to a Shiller PE of 10, which has happened in every major crash, it's trading at a 70% discount to current levels. But fundamentally sound companies don't lose 70% of their value. Their stock prices do because of forced selling. That's when generational wealth is built. Not by timing the bottom perfectly, but by having cash when everyone else is forced to sell. By 2027 or 2028, when markets recover, the investors who bought in 2025 and 2026 will have doubled or tripled their wealth. The same pattern that played out in 1932 to 1935. The same pattern that played out in 2009 to 2011. Now, here's the question you need to answer for yourself. Where are you in this cycle? Are you the retail investor holding stocks all the way down, believing that this time is different? Are you the one buying because the market just hit new highs and you don't want to miss out? Or are you the one recognizing the pattern, understanding the math, and positioning accordingly? You can't stop the cycle. It's structural. It's mathematical. It's inevitable. But you can choose which side you're on. The majority that loses wealth or the minority that builds it. The investors I've shown you, Kennedy, Baruch, Burry, Paulson, Buffett, they're not smarter than you. They don't have secret information. They just understand the pattern. They've studied the history. They recognize that human behavior is predictable, that leverage creates fragility, and that crashes are opportunities disguised as disasters. Let me give you the 3 actions sophisticated investors take during stage 3, the stage we're in right now. Action 1. Convert high-risk assets to low-risk assets. High-risk assets are anything dependent on continued credit expansion. Stocks, especially growth stocks, and in profitable tech companies. Real estate bought with leverage. Corporate bonds from highly indebted companies. These assets collapse first and hardest during crashes. Low-risk assets are cash, short-term treasury bills, gold, and essential commodities. These hold value or increase in value during crashes. In 1929, investors who held cash could buy the Dow at 89% discounts. In 2008, investors who held cash bought bank stocks at 90% discounts. The same opportunity will present itself in 2025 or 2026. Action 2. Eliminate personal leverage. If you have margin loans against stock portfolios, pay them off. If you have adjustable rate mortgages, refinance to fixed rates or pay down principal. If you have credit card debt, eliminate it. Leverage works against you during crashes. Forced liquidations, foreclosures, and bankruptcies happen to leveraged investors. Cash position investors survive and thrive. Action 3. Study the pattern, don't fight it. The pattern is documented. Publicly available. You can read Joseph Kennedy's biography. You can read Michael Burry's investor letters. You can watch Berkshire Hathaway's cash position in real time through SEC filings. The information is there. What separates winners from losers isn't access to information. It's willingness to act on information that contradicts social consensus. Right now, social consensus says the market will keep rising. Buy the dip. Stocks only go up. That's the same consensus that existed in 1929 and 2007. The investors who win are the ones willing to sell when everyone else is buying. Willing to hold cash when everyone else says cash is trash. Willing to endure being called pessimistic, fearful, and wrong until the crash proves them right. Here's the final piece. The pattern doesn't just apply to markets. It applies to currencies, empires, and civilizations. The same 4-stage cycle. Expansion fueled by credit. Overextension beyond sustainable levels. Collapse triggered by inability to service debt. Restructuring that transfers wealth from creditors to debtors, or from the majority to the minority. The Roman Empire debased its currency to pay for military expansion. Stage 1. Silent debasement. Stage 2. Hoarding of gold and silver by elites. Stage 3. Public warnings from historians like Tacitus. Stage 4. Collapse and acquisition of land by those who'd converted to hard assets. The British Empire in the early 20th century. Stage 1. Liquidation of foreign assets to fund World War I. Stage 2. Selling of colonial holdings. Stage 3. Warnings from economists about unsustainable debt. Stage 4. Loss of reserve currency status to the U.S. dollar and transfer of global wealth. The pattern is fractal. It operates at every scale. Individual assets, entire markets, national economies, global reserve currencies. The United States is currently in stage 3 of the reserve currency cycle. The same stage Britain was in 1940. Massive debt, declining industrial base, geopolitical overextension. Creditors, China, Japan, foreign central banks, are quietly reducing their holdings of U.S. Treasury bonds. That's stage 1. They're diversifying into gold, commodities, and non-dollar assets. That's stage 2. Public warnings are coming from economists like Ray Dalio and investors like Stanley Druckenmiller. That's stage 3. Stage 4 will be a new global reserve currency, likely a basket of currencies or a commodity-backed digital currency, and a repricing of dollar-denominated assets. When that happens, the wealth transfer will be the largest in human history. Trillions of dollars in purchasing power shifted from those holding dollars and dollar assets to those holding hard assets and alternative currencies. You can see this coming. The pattern is clear. The question is whether you'll position for it or ignore it. The investors I've profiled didn't get lucky. They studied patterns. They understood math. They acted on conviction when everyone else acted on emotion. And they built generational wealth by doing what felt wrong at the time but was proven right by history. You have the same information they have, the same pattern to study, the same choice to make. The difference is whether you'll act on it. The crash is coming, not because I say so, but because the math says so. Debt that can't be serviced will default. Assets bought with leverage will be liquidated. Markets that rose on credit expansion will fall on credit contraction. It's not a question of if, it's a question of when. And when it comes, you'll be on one side or the other. The side that loses everything, or the side that buys everything. The pattern is there, for those willing to look.